again, Stephen Rothstein, Managing Director of the Ceres Accelerator, that I just want to take us back from this. So 1893, the World's Fair. Folks can hear me okay? Yes? First time electricity was shown, and actually it was set up by a name we know now in a different context, Nikola Tesla. And the insurance company sent some people out there to look at what this thing was. And they came back and they faced a choice. They either could have said, oh, this is dangerous. We're not going to insure any homes with electricity. Like, we're not going to insure homes with floods or fires. That could have been one choice. And imagine what the country and the world would be like then. Or they could have, and they did go down another path, where they led to, with others, the starting of underwriter labs to ensure safety in insurance. So that's a great example of the insurance industry coming together and showing leadership that changed the way. You know, in the 1950s, the same thing happened with automobile and just road design, seat belts. So there are building codes. There are many examples where the insurance industry has shown leadership with a crisis, and it's made an enormous impact. We're not seeing that today in the broad scale we need to. There are great leaders. There are great examples. I'm going to talk in a minute about something that insurers and regulators are doing together in a very collaborative way that is helping. But we need broader acceptability, because if someone were to say to you, if you weren't here today, someone were to say to you, I know this industry, and they're voluntarily giving up on millions of customers. And there's another bunch that they're saying, we're going to not increase your rates by 10%, but I was in California a few weeks ago, by maybe $1,000, going from $1,000 to $10,000, or $1,000 to $8,000, or things like that. You'd say, well, if that was supermarkets, they'd go out of business. Well, that is the way we describe insurance. I'm from Massachusetts, and I just talked to an insurance company executive the other day who has stopped writing policies on Cape Cod and Long Island. Full stop. Cape Cod and Long Island. So it's not just Florida and California. A report came out last week that from Moody's about Louisiana, where Louisiana is projecting a brain drain because middle-class folks are going to move out because they can't get insurance. Think about the implications of that. Think about the implications. There's a colleague here from the Federal Reserve about mortgages and FHFA. So this affects, I mean, literally, if you can't get insurance at a reasonable cost, it affects every element of society. Never mind, that's on the property and casualty, but obviously on the on healthcare as well. So I'll just spend a second on Ceres. We're a nonprofit. We have folks all over. This is our 35th year of existence, a few hundred people, and we focus on climate risk. This basic idea is that climate risk is financial risk, and financial risk is climate risk. Same with water. And the more, therefore, people should have better information. And the more information you have, the better decisions you make. We work with some big investors. Collectively, our investor network is about $45 trillion of assets. So lots of assets that are moving to be net zero. And we work with a lot of regulators, including the insurance commissioners, the Federal Reserve, the FIO, and others. So what's happening around the world is there are massive debates, some court cases, about what kind of information we share. As you all know, the SEC on March 6th approved something after 2 years of active debate. We actually met with them 20 years ago. So it's been obviously a long time coming in that. And there have been since then 9 lawsuits, 7 from people who say they went too far, 2 who said they didn't go far enough. They've been consolidated. That California passed a law that said companies, in one law, it's over $1 billion of revenue, another it's over $500 million of revenue, have to do certain kinds of disclosure. That's also been sued. I'm confident both of these will work their way through, and we'll see more information. We're obviously way behind what's happening in Europe and Asia, where they are moving forward with disclosure. But there's this fundamental idea that if you have a fundamental problem, a big problem, is there any time that having more information will help you less? No, you always want more information. If someone had come to a business executive 4 years ago, middle of pandemic and said, I don't want to know any of your health data. I don't want to know where your shipping routes are. I don't understand about your supplies. You'd say, well, they don't understand the fiduciary duty of an executive. You need more information. The same thing is true with every industry, but in some ways, insurance really is the canary in the coal mine. And I appreciate, again, Rob and Dick's leadership and the team here for focusing on it today. So there's a lot of debate about should there be disclosure and what kind? Well, while that's happening, the insurance rate, this is an example where the insurance industry is ahead. So for the last 10 plus years, insurance regulators have been asking some basic information, which is good, started before some of the things TCFD. And then 2 years ago, in April of 22, the National Association of Insurance Commissioners, as you all know, insurance is all regulated at the state level. The National Association of Insurance Commissioners passed a resolution first endorsed by a small number of states, and now it's up to 27 states that are asking companies that really 80% of the industry, so not the smallest ones, but the insurers, and they're from all, property, casualty, health, everything, to share their climate data. And they're using TCFD, the Task Force for Climate-Related Disclosure, as a basis. There are a few other questions they've added, and I give them great credit. We've advocated for that. That is in some ways one of the worldwide standards, and there are thousands of companies all over the world that are using TCFD, the Task Force for Climate-Related Disclosure. So they started to require that. So the first report came in late 22. The next one came in late 23, and they're working on that. And for those of you who aren't as familiar, if you have a real life and you don't study all the TCFD rules and regulations, congratulations to you. I don't have a real life, so I actually do study this kind of stuff. But they look at 4 basic elements. It is a principle-based disclosure where they say, what is the company doing for governance? They have a bunch of questions about governance. They don't tell you what you should do, but they want you to surface what you are doing in governance, strategy, risk management, and metrics. And with the basic idea is that if you ask some of these questions, and if you share it, then the market will decide what those answers are. So it's not a pass-fail, but it has a lot more information. And again, we think it's very useful. It's not all the information we need, and this just looks at the company. There's also broader things about fire risk and obviously hurricane, physical risk, transition risk. There are many other elements of the industry, and I know you're going to talk about today. You have some distinguished speakers covering a variety of other issues. So we worked with NAIC and several of the commissioners, including particularly California, to do, we contracted with a firm to do machine learning. So this is of the data that was filed in late 22, and which is just about 480 insurers. And what does that picture tell us? And so this is on our website. It's free. Take a look at it. But it's, again, we're no longer debating in insurance, should there be disclosure? It's now the question is, what does that disclosure tell us? And so this is, again, the key elements. I'm not going to go through each of these just in the interest of time, but there are fundamental questions in governance. It says, describe the board's oversight. Well, if the board has no oversight, that's probably an issue right there, a red flag. But and then some, because I've read now many of these reports, some say we bring it up at every committee. Some say they have a special climate committee. Some say they look at it every year. There are different methodologies depending on what your company is and the size and portfolio, but at least it's transparent. I've also talked to now a number of insurers, I know there are a number in the room and online, who have said they read their competitors' TCFD reports because it helps them understand best practices. So again, there are a variety of questions in governance, strategy, risk management, metric, and targets. I'm not going to go through each one of these now, but it helps you give a good picture. It doesn't look at everything, but it does have great information. And so from the report a year ago, that what we found, and again, this is a long report, lots of data. I'm just going to spend a few minutes on, because I want to make sure we get time for questions, on that there are diverse strategies for climate risk management, which is what you would expect, different companies, different sizes, different portfolios. That there were detailed responses on risk management and strategy, less on metrics and targets. So fundamentally, they say, if you don't know where you want to go, any road will take you there. So if you have an insurance company today, or any company, and you say, there's a climate risk, we're facing a crisis, where do you want to be? Not just where do you want to be in 2050, because the average CEO of a Fortune 500 company transitions every 6.7 years. So that's really several CEO management terms. It's good to have those goals, but really, where do you want to be in 2030, 2035, 2040, and make those measurable, just like any other. So we believe every significant company should have a transition plan. Here's where we are today, and if we think about our products and services, so the services we offer, and for the insurers, the investors. Because I'll just, as a footnote, the insurance industry invests, I'm using round numbers, around $10 trillion. If you look at their combined assets under management. About $500 billion of that, with a separate report we did on this, is invested in the fossil fuel industry, broadly defined, not just oil and gas, but some related products and services, $500 billion. But it's interesting that there are 16 companies of the 400 we analyzed, 16 have $250 billion. So 16 are invested $250 billion. The other 380 have the other $250 billion. Is that too much risk? For us, we think it is, but that's up to the market to decide. So we help to share this information to kind of spur the marketplace, whether those marketplace are investors, which are a lot of our members, or students, or advocates, or regulators. We think that all of that is important. So first, for the 11 key areas that TCFD outlined, that I showed kind of a few slides ago, that 63 reports out of around 480 addressed all 11. Now, that's obviously not a good score. I'm an incurable optimist. I've spent my whole life in and around nonprofits. So I view that as a great first step. I give, again, the regulators and the insurers great steps, because again, there's not debate of should we collect the information. We're now at the what does the information mean, and this highlights that there's a real issue that there are many insurers, they're not reporting on information. So the assumption is they're probably not collecting it. If they're not collecting it, their senior managers are flying blind. And if you think about any industry, what I want, whether it's an investor with my measly 401k or a company, to have more information so they can make more thoughtful decisions. That's in a normal environment. The insurance industry, we're anything but normal environment now. So this is 78% had 6 or more of the 11. So again, for first year, we think that's good that it's out there. And all these reports, by the way, are public. They're on the department, the California Insurance Department's website. Happy to share the link if anyone wants to look at. So you can literally look at, there are 480 roughly that were filed last year. Now in the broad area, there's out of the 480, you'll see most addressed risk management and strategy. When I say addressed, it doesn't mean their answers are perfect. We didn't score, it's just, did they even address them? That's kind of a first threshold. And it just in metrics and targets, only 40% even said anything about them. So that's obviously a shortcoming, but I'm thrilled that we're in a discussion about that level, not should there be any disclosure. And so now, again, I encourage for students or academics, there's a plethora of information here. There's probably 10 master's theses just in this data alone, and encourage people. What we did was deeper than anybody else, and we barely scratched the surface just with our capacity. So there's so much more to be done. Again, this was the data that was filed in late 22. Then we went down, and again, these are all on the website, they're all free. We took 15 companies that had completed all 11 questions in some robustness and went down deep. And we don't do what should a TCFD say, but we did some great examples. And so again, we looked at, I'm not going to read all of these now, but in their management description, do they say, is the CEO measured on this? Is his or her part of his or her executive compensation? 3/4 of the largest companies in the United States, their CEOs, some of their executive compensation is based on climate now. It could be a small percent. We think that makes sense. If you're a CEO and you get and it's not part of your compensation, might that affect the priority? It might affect some of that. So we encourage you to look at that. But then do they have a management team? Is there a committee looking at it? So these just identify, again, not what their answers are, but at least what some of the questions are. Then we literally go much deeper. I'm not going to do this now in the interest of time, but in the report on the website, there's a lot of information if you want to know, you want to focus on governance, you want to focus on risk management, or I want to do a cross-reference of just property and casualty companies or healthcare companies to go from there. So again, there's detail there. I want to recognize the firm the machine learning firm we use, Manifest Climate. They do a great job and appreciate their partnership on all of this. So that was last year's data. So then the data was a year ago's data. Then the data was filed in late 23. We're finishing the analysis now. And to be honest, out of respect for NYU and the great work you do, I'm going to do a preview of the data. This has not been publicly released yet. The report's coming out in early mid-June. But we looked, there's 1,700 insurers that are 520 groups, meaning Aetna may have 10 subsidiaries or something. So we combine them because it's the same essence of that. And this is preliminary. So when the final report comes out, you may see the numbers change literally 1% or something, but we're within 98% at this point. So what's happening? It's very similar to last year. So 94% reported on risk management, 86 on strategy, 81 on governance, and only 29 on metrics and targets. So that is a big concern. If only 29%, this is again of the largest 80% of insurers in the United States are even reporting on metrics and targets. That doesn't say that their report is good, just they're even reporting on it. What does that say? So we happen to think all of these should be at 100%. And we hope that regulators say to companies, well, why didn't you even report? Eventually, we want to get to the quality of the reporting, and not eventually it's too long, but as part of that. Then we looked at it by property line. We talk a lot about property and casualty. Obviously, those are the biggest costs. And I won't go through all the statistics. I think we know those, but just kind of two quick facts that, NOAA said in the 80s that we had $1 billion storm every 4 months. Last year, we had it every 3 weeks. So if you look at the supply chain interruption, just take, one example, the Panama Canal is at, because of the drought, so they've reduced the amount of ships by 40%. So if you're an insurer, not an insurer, but an insurer, and you're insuring a company, will that company's parts or widgets be late? Will they be able to pay their bills? Will they go bankrupt? If you're not measuring that, you don't understand where it's heading, then from a safety and soundness perspective. So again, there are companies going bankrupt and pulling out of markets because of property, because of fires and floods. And we see that, unfortunately, that's a very common thing, particularly in some of the coastal states, but it's happening again, as I said earlier, all over. But it's also happening because of transition. It's happening for other reasons. So while property and casualty, again, have the biggest cost, what has cost the most lives are heat. That we're not used to, there is, I don't want to say there's none. There are very few insurance products to deal with heat issues. Florida just passed a law, which I think is ridiculous, but they passed a law that says if you're working outside in construction or a farm worker, and if you give them time off because it's hotter than it used to be, you're violating the law. Literally, that's Florida, and the governor signed that a few weeks ago. One of my sons lives in Portland, Oregon. The houses that were built up there up until the 60s, half of them didn't have air conditioning because it never thought they'd need it. Unfortunately, last summer, people died in the Seattle area because of heat exposure. So again, health insurance costs. If you want to look at a great study, the Geneva Association did a very thoughtful study about the healthcare implications and what we're going to see as the cost for insurance for healthcare companies. So again, we looked at health, life, property, casualty, title. They're very small, and just who's doing what, and it is across the board in the sense that we thought there might be some indication that property and casualty did things differently, but in fact, it's very similar. that metrics and targets, looking out in the future, is really underrepresented in there. Then we looked at it compared to last year. So green is last year, blue is the year before. It's 21 data, even though it's reported in 22. And so you'll see in every case, the green's a little higher, but not a lot. This chart to me reflects a business as usual approach. We'll work on it, we're getting better, we're in a crisis approach. So one of the things that I hope that all of us do, first is understand it is a crisis. Second is that the insurance industry has had examples, the World's Fair, auto, seatbelts, where they've shown leadership and they fundamentally changed an industry. We need that today. We need it from academics, we need it from insurers, we need it from regulators, we need it from all of us. Last year, according to the Census Bureau, 2.5 million people were forced to move in the United States. That's the United States. We're not talking international. I mean, I'm not talking about Pakistan, where 30 million people couldn't live where they were because of climate issues. 30 million people, a third of the population. And clearly, if you look at those 2.5 million, it is almost all low-income folks. So if we really want environmental justice, and we want to, not to use the word that was used politically, kind of build back better, but use this crisis to have a more equitable society in the future, we're not going to get there without insurance. Because if my insurance doubled or tripled, I would get frustrated and I'd pay the bill. But I'm fortunate enough, my wife and I are fortunate enough to do that. But there are 40% of our country, 40% of the people in our country don't have an extra $400 to spend. So if their insurance goes up 400 or 1,000 or 2,000, they literally go uninsured. So the insurance rates in our country are already going down. They've gone from the mid-90s to somewhere. It's hard to get data. That's another whole about the state versus national. We were just chatting about that. But preliminary indications are it's going down. I don't know exactly what the number is. So now imagine if and who are the people not getting insured? Who don't have that extra $500 or $4,000 or whatever it is. Those are the people that are most exposed. That according to data that only, I think the number is, and varies of course by state, 4% of the people have flood insurance. People, I won't ask you to, I've done this in many conferences, I won't ask you to do it here, but in many conferences I've asked people to raise their hand, how many people have read their insurance policy? Almost no one, again, I'm not going to ask you here, but almost no one has. And then I've said, how many of you think flood's included? Almost everyone thinks it is. Well, it's actually excluded unless you get it as general rule. I'm oversimplifying. So only 4% of the people have flood insurance. It's estimated that somewhere around 25% should, if you look at not what the FEMA maps say, but where floods are really existing. So that's just flood, not then you think about wind and fire and other kinds of risks. So we are significantly underexposed, underinsured as a country. So one of the things is this shows the state of domicile for the companies. So my hope is that every regulator, when the insurers come in next time for a rate increase or whatever their evaluation, they pull out the TCFD report and say, oh, this is public information. Tell me why you do say this and why do you say that? And I've looked at other comparisons and build it in. The regulators are very important. And I hope that every insurer will look at it and look at their 5 top competitors and read their TCFD reports. That again, the students and the professors will do. To say we scratch the surface is being generous on what we've been able to do. We've done more than anybody else, and we have literally barely scratched the surface of this. There is so much data to mine here. So I hope that many of you do kind of outperform this data and do additional work. So with that, I am, having stated this challenge, I'm just going to wrap up and then open up for questions to say I'm an incurable optimist. I think that this problem can get addressed. We've all seen the insurance industry where they've shown leadership, but we all can't go back to it's business as usual. We have to understand it's a crisis and all have to figure out what to do. And you can't manage a problem without measuring a problem. We think this is a step in that direction. So thank you for the invitation. I'm happy to answer questions.
Questions from the audience?
Do you want me to pass the mic or? Okay. If you could just identify yourself and.
Thanks. Great presentation. James Adams from NYU Tandon. So I teach financial risk management at our other campus. And so when you look at this puzzle, obviously you have fewer looking at the metrics, but measuring risk is only the second to last step in this process. The next step is to distribute that risk to others that are able and willing to bear it. So we all have some familiarity with catastrophe bonds and reinsurance and other channels of this, but maybe you could comment on how you're seeing that channel evolve over the last couple of years with climate. Thank you.
Yeah. And I know you have a distinguished professor from BC talking about cat bonds later, so I don't want to, he's more of an expert on that. But I think that fundamentally, we have to make changes in the policies that are underwritten and the investment portfolios so that there are insurers that are nervous about new products. I mean, so the country this year, or not the country, sorry, the world last year spent $1.9 trillion on new and emerging technologies. To get to where our goal says from the UN, we need to spend $4 trillion. So we have to grow everything from solar and carbon capture, whatever. I know of many technology companies, carbon capture companies, or other things that go to insurance companies and they say, I can't get insurance. So the business stops. So first is we have to have people understand these new technologies, number one. Two, I think, why are we insuring new deals like new coal deals that we know are going to be risky? Now, the good news is in the United States, 300 coal deals have come to the market that have not gotten insurance. Not because of the environmental issues, but because of the business risk. So I think we have to look at the portfolio of what's being offered and help with education. There's a company, I just read an article about a company in Florida that will not insure a home if it has this radical technology. It's called solar panels on the roof. Solar panels on the roof. I mean, because they say, oh, it's going to cause too much damage on the roof, and blah, 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 blah. I don't know why they're still licensed to do business. Literally, I don't understand it. So we have to look at the portfolios. We have to look at the financial instruments that are behind all of these. And I'm just talking about what's offered there. There is a much more fundamental issue of how the rates are set, and I'm oversimplifying, this is a whole, obviously people spend their whole life, including probably some of you, that most of the insurance rates are set backwards looking. And if we think that the climate risk over the next 5 years will be anything like the last 5 years, it's fundamentally wrong. So there are some pilots to look at those going forward. There's also some ideas like parametric insurance that I think are exciting. So there's a variety of other things. If you start with, again, the assumption we're in a crisis, you have to try new things, and then look at the investment side as well.
Excellent. So my name is Jonathan Hakim. I'm also a fellow Bostonian, and I'm with a non-profit in Boston called Insurers, which I'm sure you know. So Steve,
We love Insurers.
Good. Congrats on your report. I mean, I think it's excellent. And obviously disclosure is key here. But my concern is, do we have any evidence that this is really going to impact equity valuations and investor behavior? Because at the end of the day, we're essentially assuming that the market is going to be an efficient disciplinarian. It's going to incentivize good behavior. And my concern is that while we may have disclosure, while we may well get to higher percentages of disclosure than the numbers you showed, I'm not convinced that the market is going to be an efficient way to transform that into improved action. So I don't know if you.
It's a great question. So, I mean, I'm humbled to even answer that question with Rob and Dick sitting in the room. I mean, they're the experts in terms of market risk, so they'll talk more about that. But let me answer a little more broadly. First, that Insure, it does great work, and one of the things that they're looking at, and we're actually talking about, is this idea of parametric insurance. For those of you who are not familiar with parametric insurance, that the traditional insurance model is I'll insure my home. If I have a flood or something, the insurance adjuster will come out, will take a look, may or may not pay. That may take weeks or months to sort out. In the process, if I've had mold, the mold has grown. If my car has flooded, I don't get to work. Again, I can afford to do that, but somebody else can't. Parametric is where it's part of the insurance table, where if you sign up saying, I'm just making this up, if you get more than 2 inches of rain within 2 hours in a certain area, then everyone who signed up gets $5,000 or $10,000 or whatever the number is. So it's a micro insurance element. We happen to think it's very useful. There was a pilot done in New York. We're looking at a few other pilots. If anyone's interested, we'd love to talk to you about that later on. I'll give you 3 pieces of evidence that I think it is going to work, but it's only going to work if we all demand it and act on it. First is France started climate disclosure, their central bank, in 2016. They did a study in 2020, and of the industries that were focused on, those with fossil fuel investments had 40% less investment. So that the big institutional investors, that's not market, it's not equity value, but institutional investors were not putting money in, number one. Number two, that if you look at the biggest banks, so if you compare the insurance industry versus the banking industry, so the largest 6 banks, really maybe 8 banks, they have a lot of disclosure. When you get much smaller, they have almost none. But on those, it is making a difference. Again, Citi, Bank of America, and those others, that they have very detailed, not as detailed as we want, but detailed product by customer or customer. So what are they doing in this sector and that? And it's beginning to make an impact. I know that from many conversations. Also, Citi just came out with a report 3 weeks ago that said of their clients, they have a net zero plan. I think, don't quote me on this number, but I think it said only 42% have valid plans. So in other words, over half of them haven't thought through the plans enough. So there are examples there. So yes, there are, but data alone won't solve it. We need every company to have a net zero plan, and we have to have the what I consider the craziness in the marketplace is anti-ESG, where I'm nonpartisan, but from some conservative states, they're passing bills that say, if you have an ESG policy, you can't do work with the state. So I'll give you one example of that. State of Texas passed a law that said, if you're a bank and if you have an ESG policy, you can't be eligible for municipal bonds. So they had 6 banks before that. 5 were determined uneligible. The 5, these were big, like Wells, Citi, Bank of America. These are not, quote, liberal climate banks. These are mainstream banks. Of those, so they had 1 bank, they charged higher rates. The state of Texas taxpayers, they've now paid over $200 million more in municipal bonds. So one of the risks is there is this public debate, and it keeps going back and forth about that. And we're the only country that's having that in the level we are. So I hope we can get beyond that, because clearly there is a crisis. It is man-made. We have to move forward. When I testified with Congress last fall, and a Republican congressman said to me, Mr. Rothstein, don't you understand climate change is simply in the winter it gets colder, in the summer it gets warmer? Okay, Congressman, what do you say? So I hope we can get beyond that, and that would have a market impact as well.
I think we have time for one more.
Thank you very much. My name is Daniel Murphy from the World Economic Forum. I had a question. You mentioned there are not a lot of insurance policies or products that deal with heat. And you also mentioned it's, the most kind of deadly climate peril. And you were mentioning some, I think, innovative solutions like parametrics earlier, but curious how you see products or strategies evolving to deal with extreme heat within the industry. Given it's sort of acute, but also chronic, I think it's quite challenging for me to wrap my head around. So curious if you have any thoughts of kind of emerging solutions or products that have a lot of potential in that.
So first, I know there's some regulators here, and they may know of other cases as well, but I know, for example, the state of California, their insurance department, they set up a heat task force. That's probably not the official name, but something like that. They brought people together for several meetings, and they came up with there's a detailed report on the California Department of Insurance website about this, but they have recommendations. Part of it has to do with, like a lot of things, how do you prevent the problem? So, you know, for anything, if you can prevent the fire, well, how do you, you know, it's the bushes around your house. How do you prevent, you know, in terms of the storm, the roof hardening? So the same with heat. There's a lot of things, cooling stations and public information and alerts. So there's a lot of things that are not quote unquote insurance related, but are public policy. But it relates to insurance. Again, I'm going to go back to 1893. Setting up underwriter labs was not a quote insurance idea, but it led to safer insurance. So there's a lot of those ideas. But then we also need more heat policies, just like we have flood policies, and that people need to be aware of it. Again, if you think about a problem when the waves are literally cresting your house, or it's been 110 degrees for a week or two, it's too late to think about being proactive. And for folks without economic resources, they don't have the options. You know, if you look at Puerto Rico, Katrina, and other places. So it's working ahead, working on the non-insurance elements, like, again, design, public policy, having specific policy adjustments, increasing education so people understand what's included or not. And, you know, H.L. Mencken, the writer and author, journalist, once said, for every complex problem, there's a simple answer that's always wrong. So there is no simple answer to this, but all of those together could make a big difference.
All right, Stephen, thank you very much. Please join me in thanking